Today, we will talk about default risk, definition, types, and ways to measure. Let's learn about default risk. Default risk refers to the risk a lender takes that a borrower will not make the required payments on a debt obligation, such as a loan, a bond, or a credit card. Lenders and investors are exposed to default risk in virtually all forms of credit offerings. A higher level of default risk typically requires the borrower to pay a higher interest rate. Whenever a lender extends credit to a borrower, there is a chance that the loan, or some portion of it, will not be paid back. Default risk is the probability of this happening. Default risk can apply both to individuals and to companies that borrow money through loans or by issuing bonds. Credit ratings for debt issues are provided by rating organizations such as Standard & Poor's, Moody's, and Fitch Ratings. Lenders generally examine a company's financial statements and employ several financial ratios to determine the likelihood of debt repayment. Free cash flow and interest coverage ratio are just a couple of ways that default risk can be assessed. Rating agencies like Standard & Poor's and Moody's evaluate corporations and corporate debt to help gauge default risk. The greater the odds of default, the more that the lender or investor will expect to be compensated in terms of higher interest rates. Credit bureaus collect information on consumers, which they sell to prospective lenders and other interested parties in the form of credit reports. Credit scores are based on a number of factors, with bill payment history being the most highly weighted. A consumer who has established a reliable record of paying their bills is less likely to be risky in the future than one whose record is more spotty. If you have a lower credit score, you can generally expect higher interest rates. What happens when you default on a loan depends on the type of loan and the lender's policy. Defaulting on a debt makes an individual or company considerably less attractive to prospective lenders. It may be impossible for them to borrow again anytime soon, except at exorbitant interest rates. Defaulting on a debt makes an individual or company considerably less attractive to prospective lenders. A default can remain on your credit report and have a negative effect on your credit score for up to 7 years. Borrowers who are a high default risk will typically pay higher interest rates. Here are 4 key takeaways. 1. Default risk refers to the likelihood that a borrower won't be able to make their required debt payments to a lender. 2. The default risk posed by consumers can be gauged through their credit reports and credit scores. 3. The default risk posed by companies and governments, as well as the bonds they issue, are rated by rating agencies. 4. Borrowers who are a high default risk will typically pay higher interest rates. Hope this would help. Thanks for watching.